Welcome back to The Explainer. Today, we're unpacking the absolute ultimate retail heavyweight bout, Target versus Walmart. The Q1 2026 earnings are officially in, so let's jump right into it and see exactly what these numbers from two of the world's biggest giants actually tell us about the everyday shopper's wallet.
Okay, let's dive into this because it's a pretty unexpected twist. If you had to guess which of these two retail titans had a better time in the first quarter of 2026, well, you might actually be surprised. Target experienced a massive and honestly much-needed sales rebound. Meanwhile, Walmart posted solid revenues, which, is what we generally expect from them, but they issued this cautious guidance that actually ended up completely spooking investors. It's a classic tale of expectations versus reality. Target surprised on the upside, while Walmart, despite making just a ton of money, signaled that rough waters might be dead ahead.
Let's move to and see how this builds our understanding of the sheer scale we're dealing with here. To really get this rivalry, we first have to grasp the size difference. Walmart brought in a staggering $177.75 billion in Q1 revenue. That is a 7.3% increase. Target, well, they brought in $25.44 billion, which is a 6.7% increase. It's literally staggering when you think about it. Walmart's revenue is roughly 7 times larger than Target's. Walmart is the undisputed Goliath here. But, as we're about to see, being Goliath doesn't always mean you win every single metric.
Now, what's really interesting about this is how the smaller David actually outmaneuvered Goliath in some pretty crucial key performance indicators. While Walmart absolutely dominates in total revenue, Target actually won the comparable sales battle, posting a plus 5.6%, noticeably beating Walmart's plus 4.1%. And on profitability, no contest. Target delivered a seriously impressive adjusted earnings per share of $1.71, compared to Walmart's 66 cents. This tells us that on a store-by-store basis, Target's underlying momentum this quarter was remarkably strong, and they were highly profitable in how they executed it.
I really want to hammer home this specific number, plus 5.6%. This isn't just a minor win for Target, it is a massive milestone. This 5.6% growth is Target's strongest comparable sales showing since early 2022. For a long time, Target had been navigating a really difficult, kind of painful period of stagnant sales, dealing with inventory gluts and shifting consumer habits. But this number? It effectively ends that slump. It's the absolute proof in the pudding that their turnaround strategy is actually working, and that shoppers are actively choosing to fill up those iconic red carts once again.
So, what exactly drove this incredible 5.6% surge? Well, Target experienced some major, real-world tailwinds. Customers didn't just come back for groceries. They returned across literally all main merchandising categories. And this spending spree was significantly boosted by higher tax refunds early in the quarter. I mean, think about the joy of getting a larger-than-expected tax return. Where do people go to treat themselves? They go on a Target run. And as we all know, a quick trip for just one item usually turns into a cart full of things you didn't even know you needed. Because of this strong momentum, Target's management felt confident enough to raise their full-year revenue outlook to a very solid 4% growth. But let's transition back to Walmart, because we absolutely cannot ignore the incredible things happening under the hood of their business right now. They saw a 26% jump in e-commerce and an astonishing 37% rise in their advertising business. For a legacy brick-and-mortar retailer, those are spectacular digital growth numbers. They are successfully transforming into a total digital and advertising powerhouse. And yet, knowing these incredible top-line numbers, it makes their subsequent stock drop feel incredibly surprising, right? How does a company grow e-commerce by 26% and still leave investors feeling anxious?
Well, the answer to that anxiety lies in a single, staggering figure, $175 million. During the first quarter, Walmart had to absorb a massive $175 million in unexpected fuel costs. Why? Because of rising gas prices. When you operate the largest logistics and transportation network in retail, a sudden spike at the gas pump eats directly into your profit margins. This massive, unexpected expense totally spooked investors and led Walmart's management to actually issue a warning about a potential profit miss coming up in the second quarter. It is a harsh reminder of how vulnerable even the absolute biggest companies are to real-world operational costs.
So the crucial point is that this isn't just a story about supply chain costs. It is really a story about the people shopping in these stores. Walmart management used a highly specific term to describe this macroeconomic reality: the bifurcated consumer. This represents a really sharp divergence in shopping behavior. We're seeing high-income shoppers continuing to spend confidently, while lower-income consumers are noticeably pulling back. They are feeling the squeeze of inflation, and their wallets are being stretched to the absolute breaking point. The economy just isn't moving in one single direction anymore. It's splitting right in two.
And this brilliantly illustrates the completely differing realities of everyday shoppers right now. High-income shoppers are the ones buying those higher-margin items, keeping the top-line revenues looking solid. But lower-income shoppers? They're struggling. And here's where we connect the dots. The exact same thing hurting Walmart's bottom line, rising fuel costs, is exactly what is hurting these shoppers. The consumer's pain at the gas pump is directly mirrored by Walmart's $175 million fuel cost hit. When it costs more just to commute and live, there's simply less money left over for the shopping aisles.
Which brings us to the ultimate takeaway from this whole earnings season. Even though Target had a fantastic quarter, their management noted that they remain pretty cautiously optimistic, mainly because broader consumer sentiment indicators are definitely beginning to soften. We are looking at a highly complex landscape where tax refunds provide these temporary bursts of joy, while inflation and gas prices apply continuous heavy pressure. So I want to leave you with this provocative question to ponder. As consumer sentiment continues to soften, how exactly will this bifurcated consumer reshape the rest of the retail year? Will the confident spending of high-income shoppers be enough to keep the engine running? Or will the pullback from everyday folks force a massive shift in how these retail giants operate? Thank you so much for joining me for this explainer. Keep asking questions and keep learning.